Welcome to Earnings Intelligence, where we dive into the numbers and stories behind company reports. Today, we're going back in time to analyze a masterclass in business and communication, Warren Buffett's 1998 letter to Berkshire Hathaway shareholders.
So get this. In 1998, Berkshire Hathaway reports a massive 48.3% growth in its per-share book value. I mean, a number like that, any investor would be over the moon, right?
So, on the surface, it looks like just an absolutely perfect year for investors. But was it really as good as it looked? Well, right in the opening of his letter, Buffett himself comes out and basically throws a bucket of cold water on that huge number. He says, and I'm quoting here, Berkshire's progress in 1998 was not as good as it looks. Whoa. Okay, so that sets up a pretty interesting puzzle for us to solve. Let's dig in.
All right, so here's how we're going to break it down. First, we'll look at why that spectacular year wasn't so spectacular. Then we'll get into Berkshire's two value engines. We'll peek inside the business empire, uncover the Buffett philosophy, talk about the challenge of staying great, and wrap up with some timeless lessons from 1998.
Okay, Section 1, a spectacular year? Let's get right to it. Why would a 48.3% gain not be as good as it looks? Well, the whole answer is really about understanding the difference between two super important ideas.
So Buffett lays it out pretty clearly. Most of that big gain in book value came from issuing Berkshire stock to make acquisitions, specifically a company called General Re. Now, because Berkshire stock was trading at a huge premium, this move instantly inflated the accounting number. But, and this is the key, it didn't create a dollar-for-dollar increase in the company's true underlying business value, what Buffett calls its intrinsic value. It's an accounting quirk, not real fundamental growth.
So to get to the real performance, Buffett basically splits the company in two. He says, look, you got to see us as two totally distinct parts. Let's move on and see how this whole thing builds out.
All right, so here are the two engines. You've got the investments, that's the big portfolio of stocks and cash. And then you have the operating businesses, the actual companies Berkshire owns and runs. In 98, that investment portfolio, it grew by 25.2% per share. Not bad at all, right? A lot of that was thanks to the General Re deal. But, and this is a huge but, the per-share operating earnings, they actually fell by 33.9%. That's a big drop, and it was mostly because that same new acquisition, General Re, had a rough year with its underwriting.
Now, what's really interesting when you look at this table is the trend. Yeah, 1998 had some, let's call it nuance in its numbers. But zoom out and look at the 5-year picture. You see this dramatic growth across the board. Revenues, net profit, the whole company's equity base. It's a rocket ship.
All right, let's talk about the debt-to-equity ratio. This is a big one. It basically measures a company's financial leverage. Think of it like this, right? It's like the mortgage on your house. If your house is worth, say, $500,000 and you only owe $20,000, you've got a super low debt-to-equity ratio. You're in a really, really safe financial spot.
So what was Berkshire's number in 1998? Get this. 0.04. That is incredibly low. For every single dollar of its own capital, it only had 4 cents of debt. I mean, that's not just a strong balance sheet. That's a financial fortress.
Okay, next up, inside the business empire. We're going to look at how those operating businesses, that second engine of value, were actually doing. And really, the star of the show here was, without a doubt, GEICO.
So this is a fantastic story. Being owned by Berkshire gave GEICO this incredible freedom to focus on long-term growth instead of worrying about Wall Street's short-term profit demands. So what they do? They just massively ramped up their marketing spend, from $33 million to $143 million in just a few years. They knew it would ding their earnings in the short run, but that they were building enormous, enormous long-term value.
And guess what? It worked. Big time. GEICO's auto policies in force just exploded, growing from 2.3 million to over 3.5 million by the end of 98. This is just a perfect illustration of the power of Berkshire's whole structure, right? They provide the capital, they provide that long-term mindset, and then they let great managers like GEICO's Tony Nicely just go and execute their vision.
And GEICO was just one piece of the puzzle. Berkshire back then was this surprisingly diverse empire of wholly owned businesses. I mean, you've got everything from See's Candies to the Buffalo News, Nebraska Furniture Mart, even a company that sold fractional ownership of private jets. It's an eclectic mix, for sure.
All right, so let's get into the Buffett philosophy. What's the core idea that ties this whole sprawling empire together? Well, a huge part of the answer is hidden inside the financial engine of the insurance business. Okay, let's talk about insurance float.
This is absolutely crucial to understanding Berkshire. Basically, it's the money an insurance company collects in premiums that it gets to hold on to and invest before it has to pay out any claims. In 1998, Berkshire was sitting on $22.8 billion of this stuff. So here's the magic trick. Buffett sees this float as a massive interest-free loan from all the policyholders, and he can invest that money for Berkshire's own benefit. It's literally the rocket fuel for the entire investment engine.
And when it comes time to deploy that capital, to use that rocket fuel to buy new businesses, Buffett and Munger have this famously simple and incredibly disciplined checklist. They're looking for large purchases, businesses with consistent earning power, good returns, and little to no debt. And notice what's also on there: management already in place, and simple businesses. They're not interested in turnarounds or some complex tech they don't get. It's just so straightforward.
Their management philosophy is just as simple. As Buffett puts it, most of our managers wouldn't work for us if they got a lot of backseat driving. I mean, it's brilliant, right? Find the best people in the world and then just get out of their way. And they really walk the walk. There are only about 12 people at headquarters. It's the ultimate example of decentralized management.
Okay, Section 5, the challenge of staying great. You know, despite this unbelievable track record, Buffett was always incredibly honest, almost blunt, about the future and the challenges that came with Berkshire's own massive success.
So he actually set a goal in the report to achieve an average 15% annual gain in intrinsic value. And listen to this, he called that the very peak of possible outcomes. He was basically warning shareholders, hey, this company is enormous now. The crazy high returns of the past, they're just not possible anymore. The law of large numbers was finally catching up to.
All right, let's wrap this up with some timeless lessons from 1998. Because when you read this report now, over 2 decades later, the most valuable stuff isn't really the numbers themselves. It's the principles behind them that are just evergreen.
So what are the big takeaways from 1998? First, focus on intrinsic value, not just the accounting figures. Think like you owned the whole business, not like you're just trading a stock ticker. Demand honesty and transparency from the people running the show. Understand that having a fortress-like balance sheet gives you incredible freedom. And finally, let great managers do their thing. I mean, these are the absolute core tenets of the Berkshire Hathaway philosophy, and they're just as relevant today as they were back then. It's a blueprint for rational, long-term thinking.
So that leaves us with a pretty big question, right? In a world that is completely obsessed with the next quarter's earnings, are these lessons in long-term thinking more valuable today than they've ever been? You know, this 1998 report, it isn't just a financial document. It's really a guide to thinking clearly about value. Thanks for joining us on Earnings Intelligence.